Hi, I'm Vansha. I'll start with the first topic of the day, why some stocks become multi-baggers. When we talk about multi-baggers, most people imagine sudden explosion in stock prices, but in reality, multi-baggers are almost always the result of steady, consistent progress happening quietly in the background. These companies keep improving a little every quarter, and the market usually doesn't notice it immediately. But over a few years, all those small improvements start compounding, and that's where the magic begins. What's interesting is that many multi-baggers don't start as famous companies. They are often small, overlooked, or operating in areas nobody finds exciting. But they have something unique. It could be a niche product, a cost advantage, or simply a management team that does things better than competitors. When these advantages compound, the stock's value compounds too. And the truth is, patience is a major ingredient. Even the best companies need time to show their real potential. Early stage firms like Magnetech look ordinary from the outside, but investors who recognize the early signals and stayed invested saw extraordinary returns. So multi-baggers aren't really about finding something magical. They are about understanding consistent performance and giving it enough time to shine. Now that we have understood why some stocks become multi-baggers, let's move to our next topic, how to spot a good company in bad industry. A lot of times we judge a company based on the industry it belongs to. If the industry is shrinking or most players are losing money, it's easy to assume that the business in that sector must be weak. But that's not always true. Even in the most troubled sectors, there are always one or two companies that operate differentially. They stay efficient, manage costs better, and continue to attract customers while everyone is falling behind. What you are really looking for is a company that behaves like an outlier. When the whole industry is cutting corners or piling on debt, this company keeps a clean balance sheet. When competitors struggle with pricing or product quality, this one maintains consistency. Over time, these small differences add up and create a gap between the company and the rest of the sector. And you can spot this gap quite clearly. While the sector pattern shows declining sales or shrinking profitability, this particular company continues to grow. It gains market share because consumers naturally migrate to the player that delivers the better value. This is why a good company in a bad industry stands out so easily. Not because it's doing something flashy, but because it's simply more disciplined than the rest. It's very similar to finding the one green plant in a dry field. The environment isn't supportive, but the plant survives because its internal strength is better than the rest. And companies like these often reward investors the most because the market takes longer to recognize them. With that idea, let's shift to our next topic, how simple everyday observations in real life can actually lead to meaningful stock ideas. Powerful way investors can find promising companies by paying attention to what they see around them in daily life. Many great investments begin with simple observations, noticing which products people are excited about, which stores are full, or which brands seem to be gaining popularity before anyone is talking about them. This approach works because real consumer behavior often changes long before the financial numbers show it. When a business has created something that customers generally like, you can usually feel the momentum in everyday settings. Whether it's a restaurant that's suddenly crowded, a new retail chain expanding quietly, or a product that people around you keep buying again and again. These consistent signs of demand often point to companies that are executing well behind the scenes. They tend to manage operations efficiently, keep consumers satisfied, and build strong reputations without relying on hype. When such patterns keep repeating across different locations or over a period of time, it becomes signal worth paying attention to. The idea is simple. If something is clearly working in the real world, there is a good chance the business behind it is doing something right. And identifying that early before the stock fully reflects it can become a meaningful advantage for any investor. Now that we have understood how everyday business can turn into a real investment ideas, Yash will go ahead and take us to slide 4.
Hi, I'm Yash, and I'm going to be covering the next few slides of this presentation. A lot of times, what happens with retail and restaurant chains is that these companies are doing better than others. If you're, let's say, go to a mall and you see just a couple of stores doing better than their competitors. Now, it happens because maybe that company has a better product, maybe better services as well, and also consistent ones. Another thing happens is that when one store does better business than its competitors in, let's say, a couple of regions, now when they do capex and start selling their products in other regions of the country, they still do well. This is because their product has already been tested in one area of the country and is more probable to succeed in the other area of the country. Now, these trends can be very easy to spot if you actually go and see how the business operates. It can be a little harder to do that through just annual reports because they come out at the end of the year. For example, the author's daughter tended to like tend to like Gap. It made jeans that were more popular with teenagers because of their attractive designs and colors. Another example that I can give you is The Body Shop, an England-based company that only had 90 stores in 1983 in the US. And that was clearly not enough, especially for for the demand that they were showing. And yet, they didn't rush with capex and were really cautious with opening more stores and actually ended up making 50 times the money invested for their shareholders. Now, moving on to the next slide. Now, sometimes some stocks look better on the inside than on the outside, and that's what makes them the gems for stock pickers. Maybe they had a not such a good quarter or two. Maybe the industry wasn't really trending. And yet, when you look in the annual report and their balance sheet, they're doing much better than the market sees. A lot of times, what happens is in these downturns of the business, the company actually is trying to improve its operational efficiencies and become the low cost producer. A lot of times, they are reducing their debt, and yet the market doesn't show that. And that is what ends up making these companies undervalued and such a gem for a stock picker. An example for this could be Chrysler, a US automaker that wasn't doing so well during the downturn of the automotive industry in 1982. Its stock was trading at $2 a share. And it was expected that the company would go bankrupt within next 2 years. Yet the company, in its cash reserves, had $1 billion. So what ended up happening that nobody was paying attention to this stock, and within the next couple of months, they reduced their debt and also came up with some really exciting models that ended up doing really well in the next few years, which actually ended up making the business a 60 bagger for its shareholders. So that is it from my end, and the next presenter will take it from it. Thank you.
I'm Zalak and I'll be covering next few slides of the presentation. Cyclical companies move almost in rhythm with the economy. When business activities picks up, their sales and profits climb quickly. And when the economy cools, they slow down just as fast. What often confuses investors is how extreme the swings can look. A company that seems weak during a slowdown isn't necessarily a bad business. Many of them are simply tied to demand that comes and goes in waves. What's important to understand is that the stock market usually reacts much earlier than the actual economy. When a cycle is near its bottom, the numbers still look terrible, but the stock may already be preparing to turn upward. This is because improvement often starts quietly. Maybe orders begin rising, inventories start reducing, or customers returns gradually, long before the full recovery shows up in earnings. On the other hand, when times are great and profits are at their peak, the market may already be anticipating a slowdown. That's why buying a cyclical stock just because it looks strong in good times can be risky. While the best opportunities often sit in periods when the company appears to be struggling but is actually on the verge of improving. With that, let's move to the next slide, opportunities in downturns. Downturns are uncomfortable, but they often uncover the clearest opportunities when sentiment is negative. Even well run companies get punished along with the rest of the market. Their stock prices fall faster than their actual business performance, and this mismatch creates an opening for the investors who can look past the fear. What usually happens behind the scenes is very different from what stock chart shows. Strong companies use slow periods to tighten their operations, improve efficiency, and prepare for the next phase of growth. They may streamline cost, refine products, or strengthen their balance sheet while competitors struggle. These quiet improvements don't show up immediately, but they position the business to rebound sharply when conditions start turning. Another key point is that recoveries begin long before the headlines sound positive. The earliest signs are usually subtle. Better sales in a few regions, rising orders, or stabilizing margins. The market often reacts to these early signals much faster than most people expect, and that's why opportunities are greatest when the overall environment still feels negative. Downturns also make the difference between strong and weak companies very clear. Businesses that survive without heavy borrowings or panic decisions often emerge stronger on the other side. With that, let's move to the next slide, importance of checking up on stocks. Buying a stock isn't the finish line, it's the starting point. Companies evolve constantly. Their sales can speed up, slow down, or even reverse without any warning. If we don't check in regularly, we end up reacting late, long after the market has already moved. Regular updates help you understand whether the business you invested in is still following the path you expected. Sometimes a company quietly takes on more debt, or its margin starts shrinking, or competition intensifies in its industry. These changes don't always make headlines, but they show up in quarterly numbers, and that's where careful tracking becomes useful. Monitoring result also tells you if the company is improving behind the scenes. Many firms strengthen their operations gradually. Maybe they are expanding into new regions, cutting unnecessary cost, or launching products that can lift future growth. These early shifts are much easier to catch when you are actively keeping an eye on the business, not just the stock price. Consistent checkups prevent you from holding something that's no longer the same business you originally believed in. And at the same time, they help you spot early signs of recovery in companies that were struggling earlier but are now turning around. With that, I'll hand it over. Now, the next presenter will take you to the further topics.
One of the biggest challenges in investing is not finding the right stock. It's staying calm after you buy it. Market move up and down all the time, and those dips can feel uncomfortable. But most of the time, these short-term falls have nothing to do with the long-term strength of the business. A solid company can temporarily look weak because of the news, sentiments, or overall market mood. If we panic during these phases, we often lock in losses even though nothing is actually wrong with the business. On the other hand, when you stay patient, you give the company time to recover and grow, and you get rewarded for holding through the noise. Good investment usually take time to show their full potential. That's why discipline after buying the stock becomes just as important as the research you did before buying it. If you react to every tip or headlines, you end up working against your own strategy. By staying patient and focusing on how the business is actually performing, not how the stock fluctuates day to day, you avoid unnecessary mistakes and allow compounding to work for you. With that thought, let's move to the slide 10, learning from missed opportunities and mistakes. In investing, nobody gets everything right. Missing a great stock or making a wrong call is normal. What really matters is how we use those moments to sharpen our judgment. Every time we look back at the missed opportunity, we usually notice something we didn't pay attention. Maybe the company was growing steadily, maybe the numbers were improving quarter after quarter, but we didn't connect the dot at that time. The point is not to feel bad about missing it, but to understand what the pattern looked like so that when a similar situation appears again, we recognize it faster. Sometimes our mistakes come from emotions, selling too quickly, hesitating too long, or reacting to noise instead of data. Becoming aware of these tendencies help us to prevent repeating them. And small mistakes actually become useful because they teach us where our processes need strengthening. If the same type of mistakes keep slipping us past, that's feedback that we need to adjust how we evaluate businesses. Over time, these lessons quietly improve our ability to spot winners earlier and avoid avoidable losses. With this understanding, Virti will now take you through the next set of topics.
Hello, I'm Virti Khandur. Let's look at the next slides. When you look at a company like Fannie Mae, you see an example of how steady, repetitive businesses can quietly deliver powerful long-term results. One of the core ideas in thoughtful investing is recognizing that you don't always need dramatic growth stories. Sometimes the most reliable performers are the ones doing essential work in the background day after day. Fannie Mae's role in the housing market is very straightforward. It helps keep money flowing between lenders and home buyers. And because housing is such a fundamental part of the economy, that activity continues through all kinds of market environments. This is the type of business where consistency becomes its strength. Even when it isn't in the spotlight, the earnings build, the influence expands, and the value compounds over time. Another takeaway is the importance of understanding where a company sits in the broader economic system. With a company like Fannie Mae, shifts in its activity can offer early hints about changes in housing demand, credit conditions, or overall market sentiment. Paying attention to those clues often helps investors spot trends before they become obvious. With those ideas in mind, let's move on to slide 12: Timeless Lessons, Golden Rules, and Key Principles. So, at this point, these book concepts really come together into some basic principles that make investing a lot more manageable. One thing that stands out is how much easier it becomes when you don't just go along with what everyone else is doing. If you can stay calm and think for yourself, you already avoid a lot of common mistakes. Another helpful lesson is not trying to follow too many companies. It's honestly better to really understand a few businesses than to spread yourself thin. When you actually know how a company works and what affects its performance, you make smarter decisions and you don't panic as easily. It also matters to be honest with yourself about your own tolerance for risk and volatility. Some people can handle big price swings and others can't, and that's completely fine. What's important is choosing investments that match your personality so you don't make emotional decisions later. And something I personally found useful is the idea of always learning, whether it's reading reports, paying attention to trends, or just observing how good companies operate. All of that adds up over time and helps you improve as an investor.
That wraps our discussion on the book Beating the Streets. Now we'll move towards second part where we cover theme-wise updates from recent articles, starting with theme 1, which is gold. Gold has always been viewed as safe haven asset. Whenever the world faces uncertainty, whether it's inflation, currency volatility, or geopolitical tension, investors naturally move towards gold because it's protecting the purchasing power. It's also an important part of global central bank reserves, which is why many countries steadily keep adding to their gold holdings. Now we'll move now we'll look at the updates for this theme. In 2025, gold saw a massive rally, rising over 50% year to date, fueled by global uncertainty and rising geopolitical risks. This surge pushed India's gold imports sharply higher, adding pressure on the trade deficit as domestic demand stayed strong. Regulators also stepped in. SEBI warned against unregulated digital gold products, encouraging investors to use gold ETFs instead. Another key trend was affordability, with prices crossing over 1.3 lakh per 10 gram. Many consumers shifted from 22K jewelry to 14K or 18K options. Globally, the US Federal Reserve's rate cut supported the rally by reducing real yields. And events like freezing of Russia's dollar reserve reminded countries of the importance of gold as a politically neutral reserve asset. So overall, 2025 strengthened gold's role both as a safe haven asset and strategically geopolitical hedge.
Moving on, our second theme is about China Plus One. China Plus One has basically become the go-to strategy for global companies who don't want to keep all their manufacturing in one basket anymore. COVID, supply chain shocks, and US China tensions made firms realize how risky single country dependence is. So now the idea is simple: keep some production in China and shift the rest to countries that are more stable and cost competitive. Now, coming to the recent developments around this theme. India is definitely one of the biggest contenders in this shift, but we still face the usual hurdles: slower approvals, lower R&D investment, and policy complexity compared to places like Vietnam or Thailand, which is why they still attract a lot of early projects. But despite these issues, India is gaining serious momentum. Apple suppliers are scaling up fast, and if current plans hold, India could be making about a fifth of all iPhones in the world. It's not just electronics. Automakers like Suzuki and Hyundai are also building out India as a base for EV batteries and key components, which is a big signal that supply chains are moving here for the long term. The government is also pushing critical inputs like rare earth magnets with PLI support of over Rs 7,000 crore. because without that, we can't compete in electronics or EVs globally. And interestingly, even the energy storage sector is picking up interest. Companies like Fluence Energy are exploring India for BESS manufacturing, which shows that this diversification wave is spreading beyond traditional sectors.
Hi, I'll be covering the next two themes of our current affairs part of the presentation. One, Sensex. Sensex is India's benchmark equity index. Everyone tracks this, from professional investors to retail ones. It reflects how macroeconomic trends are going, how corporate earnings are affecting our market. RBI rate cuts were expected by the market because RBI governor said that there was in fact more room for policy easing. Rumors from the US also led to a growth in Sensex. Sensex reached new heights in November third week. The last time it happened was last year September. It especially affected the auto and the finance sector. Even though there were net FDI outflows in August and September, yet strong DII inflows made the market stable. Sensex did face some corrections due to profit booking, yet overall market trend remained bullish. Positive data and moderate inflation has supported the rally. In terms of earnings, though, earnings growth for Sensex for FY26 is expected to be low double digit. Yet, earnings growth for Q2 FY26 was a mere 1.2%. On to the next theme of policy rate cuts and CRR rate cuts. Policy rates, also known as repo rates, are the rate at which RBI lends to the other financial institutions. CRR stands for cash reserve ratios that the bank has to keep as cash with RBI. Now, CRR stayed at 3%. The repo rate has been cut by 25 basis points from the previous 5.5% to the now 5.25%. In terms of liquidity, before the rate cuts, the weighted average call rate stayed at 5.42%, but now stands at 5.2%, showing there is ample liquidity in the system.
Moving on, our next theme is about PLI, Production Linked Incentive Schemes. PLI schemes are basically India's way of boosting domestic manufacturing across strategic sectors. The idea is to reduce import dependence, create jobs, and attract investment in areas like electronics, EV batteries, specialty steel, and rare earth magnets. Now, coming to the recent developments around this theme. PLI schemes are gaining traction across multiple sectors. Specialty steel is seeing fresh rounds of investment, while the auto sector has received significant payouts, signaling strong government backing. Electronics and battery manufacturing are expanding too. Despite some delays in battery production, firms are planning over 100 gigawatt capacity, showing long-term confidence in India as a hub for EV supply chains. MSMEs are also benefiting, especially in electronics and white goods, as the government encourages broader participation beyond just large companies. Overall, PLI has already contributed to trillions in sales and over a million jobs, reflecting both economic and social impact. And with initiatives in rare earth materials and strategic components, India is aiming for global competitiveness, making sure our supply chains aren't overly dependent on any one country. Moving on, our next theme is about tariffs. In 2025, the US imposed steep tariffs around 50% on selected Indian goods like textiles, marine products, and electronics. While this created short term challenges for exporters, the overall impact on India's GDP was limited. India quickly responded by diversifying exports to other regions and exploring defensive measures, especially in sectors like steel. Now, coming to the recent developments around this theme. India's goods trade deficit did see a spike reaching over $41 billion in October 2025, and exports to the US fell slightly. But India was able to navigate this shock by redirecting shipments to Europe and Asia, keeping overall trade resilient. The US eventually rolled back tariff on agriculture items such as coffee, tea, spices, and fruits, easing political pressure on providing relief worth billions for exporters. On the energy front, India expanded its trade with the US, signing contracts to import LPG, while domestically, adjustments in gas tariffs and discussion on public goods affordability showed proactive management. So, while tariffs posed a challenge, India demonstrated ability in both trade diversification and strategic energy deals, ensuring the macro impact remained minimal.
Moving on our next theme, that is AI. AI has rapidly shifted from experimental tool to a core growth driver across big tech, Indian IT, startups, and even creative industries. The big change is moving from generating information to actually performing tasks, what we call agentic AI, which is forcing companies to rethink business model, talent structures, and infrastructure. Now coming to the recent developments around this theme. Globally, AI investments are exploding. Google, OpenAI, Microsoft, and Nexus are racing to build the next generation of AI, pushing research infrastructure and AI platforms worldwide. In India, IT and startups are shifting to AI-led platforms, automation, multi-step tasks that were previously manpower intensive. This is driving structural shift. Some mid-level IT roles are shrinking, while high-paying AI roles are booming, with packages going up to 1 to 1.6 crores. Beyond IT, AI is touching every sector. Companies like Microsoft are doubling down on India, investing billions and hiring tens of thousands of AI engineers, signaling that India is becoming a serious hub in the global AI landscape.
Moving on further, we focus on the key economic and financial indicators driving India's growth. GDP and GVA both grew 8.2% in Q2 FY26, powered by strong services and manufacturing activity. PFCE also shows robust consumption, highlighting domestic and demand strength. CPI rose slightly to 0.71% in November, driven by food price volatility. This signals that inflation remains manageable but supply sensitive, prompting the RBI to maintain a careful stance. Speaking of which, the repo rate was cut to 5.25%, a proactive move to support domestic credit and broader economy amidst global uncertainties. India's FX reserve remains stable at around $686 billion, providing a strong buffer against external shocks. Further indicators will be presented by Zalak.
Capital flows, while FII recorded significant equity outflows, domestic institutional investors fully absorbed the sell-off. At the same time, FDI inflows remain robust, showing confidence in long-term investment. Looking at activity indicators, manufacturing PMI stands at 56.6, indicating continued expansion and resilience in domestic orders. Service PMI is even stronger at 59.8, confirming the service sector is driving GDP growth. Finally, the digital economy is showing its strength. UPI transaction crossed 20.47 billion in November, signaling deeper digital adoption, broadening of the tech space, and increasing formalization of the economy. Overall, this indicators collectively highlights India's economic momentum, policy support, and resilience in financial flows.
On to the high frequency data and market indicators. WPI stood at negative 1.21% in October, and consumer food price index stood at negative 3.91%. Government security 10-year yield stood stable at 6.58%. GST collection stood at 1.7 lakh crores, a bit lower considering the GST rate cuts. E-way bills at 129.8 million transactions shows good movement of goods across states. Balance of payments stood stable at 1.3% of GDP, showing moderate trade balance. Credit growth stood at 10% year-on-year growth, which shows that if we want to grow at a nominal rate of 12%, we have to lend more. Credit deposit ratios also stood stable. US CPI stood at 3% and Fed rate stood at 3.75%. Due to the low inflation and lower Fed rates, US yields have dropped to 4.05%, leading to FII outflows out of India because the yield gap has shrank between India and US. During H1 FY26, net FDI inflow was at $7.64 billion, yet during August and September it was negative. The reason for this, the lowering US 10-year yields. From all of us, thank you very much for watching our presentation.